Good afternoon, and thank you for joining us for today's Real Estate Digest on data centres. We're delighted to have such a strong panel and host for one of the sector's hotter topics. It's important we recognise and discuss the opportunity to benefit from access to data centre returns in Europe through the ownership of equity and debt in listed real estate companies like SEGRO and Merlin Properties. Please keep an eye on our website and emails for similar webinars and events. We look forward to seeing you in person at our January Insight events in London, Brussels and Paris, and online for DACH, Nordics and CEE. I will now leave you in the capable hands of Rob Jones, Executive Director, European Equity Research at BNP Paribas Exane. He will moderate the panel and ask any questions that you send through the chat. And Rob, without further ado, thanks in advance for your help, and over to you.
Good stuff, Matt. Thanks very much. Much appreciated. Yes, so for those of you who don't know me, I'm Rob Jones. I head up real estate equity research here over at BNP Paribas Exane. We cover many different sectors, one of those being logistics and DCs. Two of our coverage companies are both Merlin and SEGRO, and I'm delighted to have representatives from both of those companies here with me today, as well as one of my colleagues from BNP Paribas Real Estate. First and foremost, let me pass over to the panelists to introduce themselves in terms of who they are, what they do at their organisation before we get into the Q&A, and we'll do it in order of Andrew, Francisco, and then Mike, if that's okay. Thanks.
Thanks very much, Rob. Hi, everyone. Andrew Pilsworth, Chief of Staff and a member of the Executive Committee at SEGRO, and amongst my responsibilities is responsibility for our group data centre strategy.
Here, Francisco Rivas. I'm work in Merlin Properties since inception, covering or leading basically the business development department, where now data centers basically comprises most of our efforts right now. So happy to be here. Thank you for the invitation.
Hi, I'm Mike Umfreville. I head up the data center team at BNP Paribas Real Estate. I focus mainly on land buying for data center operators and users. But then I also help undertake some real estate due diligence on data center assets.
Cheers, guys. Thanks very much. So we've got a few questions to get through. As a reminder for the audience, if you do want to ask a question, click on the Q&A box at the bottom of this. Start getting in your questions now. Once I've finished with my questions for the panelists, I'll then start answering yours. We'll do about 45 minutes from myself and about 10 to 15 in terms of your Q&A at the end. So please start asking those questions now, and I'll get through them for you. So first and foremost, setting the scene, we have a number of people on this call, more than 100 already, that have a wide range of knowledge in terms of DCs. And I wonder if we could just set the scene in terms of what market participants mean, first of all, by the 3 Ps, how that impacts your business. And maybe I'll pass over to you, Andrew, just to talk about kind of DCs from a top-down perspective initially.
No problem. Thanks, Rob. So most of you will be aware of SEGRO. We're a UK-listed, FTSE 50 listed real estate investment trust REIT, and we're coming up 104 years old now. And in data centers, we've been operating in the data center space for more than 20 years now. So we've got mainly on the Slough trading estate. So we've got more than 30 data centers there, and our first one, to say, was in 2005. And most of you will be familiar with our business model. We're an owner, manager, and developer of industrial real estate, and the model we employ for data centers reflects that. So all of those 30 data centers on the Slough trading estate, which is actually the Europe's largest hub of data centers, it's grown over that time. They're all what we term either dark or powered shells. So same model, as I say, that we employ elsewhere. We developed all of those over that time. So we built the shell and we lease it to our customers on a long-term basis. Variety of customer there, DC operators. Those operators in our business model then deliver. They pay for and fund and deliver the fit out to the building. So for us, it's a real estate investment like the rest of our business in our urban and logistics portfolio that we build and develop the shell. So really important part of our business, currently accounts for something like 7% of our total business. But we also have, in addition to those 30, we've got a big pipeline in DCCs as well, in the existing markets that we already operate in the 8 countries that we operate in the UK and continental Europe. Got a pipeline of 24 sites with a relatively high bar we've applied in terms of, Rob talked about the 3 Ps, the power and planning, which are 2 of the, along with proximity to be in the right location for data centers with access to fiber and near end use customers for the cloud. The other 2 are power and planning. So for those 24 sites, we've got a high degree of confidence for power and planning. And on the power, we've got more than 1 gigawatt of power either secured or at advanced stage for that pipeline. So in summary for us, you know, we'll talk about it on the call today, very high growth segment of the market. We've got a pretty deep expertise in the area of the market that we operate in terms of the powered shells, and a big hub at Slough Trading Estate. And we've got a big pipeline of future DC opportunities, 24 sites and more than 1 gigawatt of power secured. So it's a really, it's a growing, a really important part of our business.
Okay, interesting. Thanks, Andrew. Mike, obviously you work for and with clients looking for sites, and a number of kind of strings to your bow at BNPP Real Estate. I wonder what your clients are saying to you with regards to the various criteria of a site, what's most important for them, you know, what are some of the sticking points for them when you're thinking about a site that is appropriate for them, or trying to, you know, marry up, you know, a transaction between buyer and seller. What are the, you know, kind of, I guess, what are you looking for as part of your role on behalf of that client, I guess is the question.
Yeah, so I think fundamentally there's an underlying story to data centers at the moment and across Europe, frankly, not only in the UK, but power is highly restricted at the moment. And to everyone's frustration, the demand is huge and the power is very restricted. So it's a bit of a difficult situation. So where data center operators are finding power is probably in the more secondary markets. So they're willing to be sort of taken slightly further outside of the required areas, assuming there's the right amount of power there. Clearly, obviously, planning is really important as well. And there's no point having a big site with lots of power if you're not going to be able to get the planning on it. And clearly, with the Labour government coming in the UK, that's potentially opening that up, because data centers are now seen as part of nationally important infrastructure. But finally, they're also very aware and conscious of these sites will not run themselves. They need to have people nearby, and they need to be in locations whereby, fine, you can get the power, you'll be able to get the planning, but you also need to be able to have the people to work the facilities, manage the facilities, and maintain them. So those are the sort of key drivers as a lot of my clients see it, I think.
Okay. And have you seen a pickup in demand from your clients' perspective in terms of the quantum of capital chasing that opportunity?
Yes, fundamentally, yes. There's more being invested into the platforms. You've got big infrastructure funds, like the recent one would be Digital Bridge investing. They've just bought Yonder, for example. There's a lot of money that's trying to get into the sector, especially when you look at, I suppose, the headline grabbing part of the sector, which is probably more the cloud focus area. So the likes of Microsoft, Amazon, Google, these guys are referred to as hyperscalers, and there's a lot of capital trying to get hold of effectively the lease value that these people will offer, or these businesses will offer.
we'll talk about potential returns in a minute, and importantly also potential returns relative to other subsectors like logistics, for example. But Francisco, we've spoken in the past about that quantum of capital chasing DCs in Europe, and B, I guess some concern or some kind of thought process around to what extent you need to be a subject matter expert, or do you just need to have capital to buy sites and start developing? Now, I'm guessing yourselves and indeed SEGRO would both argue that you are subject matter experts, either because you've done this for a number of years, not quite 104, but a number of years, or because you have the right teams in place to execute on your DC strategy. But tell me, Francisco, why? I guess why do you think Merlin has an edge relative to someone else who might be looking to grab market share in your specific markets, or maybe what investors underestimate about the challenge of growing a DC portfolio, for example?
Yeah, so as you said, basically we enter in this new business in 2020, so which looks like was yesterday, but in this market as it is growing, a lot of things have changed since. So the market basically was completely underdeveloped here in Spain, probably Europe, I would say, basically as a reference. So if you see basically the capacity already installed in the US as compared to Europe, you will find basically that we're like 1/3 of the capacity already available in the US, which basically means that we are not really well developed. And on top of it, basically all of that capacity has been concentrated in a couple of markets. So now basically as the power is some of the restrictions or the planning or proximity, people, procurement, all of that, basically now people are looking and clients are looking for other locations. And we have been blessed by the luck or by God basically to have several things here down in Spain and Portugal. We have renewable energy in amounts that we cannot consume as of now, so basically put us in a very good competitive situation as compared to other regions. Second, basically we have a fantastic connectivity because all the submarine cables that are arriving in Europe from North America, South America, Africa, and Asia, basically most of them are entering through Spain and Portugal. In some of the cases, only through Spain and Portugal. So this gives us basically this location a very good opportunity, and based on that is what basically drove us to move into this sector, which, as you commented in your question, sometimes a little bit misunderstood or underestimated basically the capacities you need. Of course, there are different approaches to this business. So SEGRO, Andrew explained perfectly basically on the core and shell type of investor. We are going a little bit step further, equipping a little bit larger the data centers and trying to operate basically all that mechanical and electrical equipment. And then, of course, there are other approaches which are, out of REIT, at least European REIT conception, which is basically do colocation business and then try to basically enter into servers and stuff like that. So we are, because of our legislation, probably SEGRO as well, where basically this is out of our, objective in this market. So what I would say basically is that there are several barriers. It's not only capital, but depending on the approach you have to the business, sometimes basically you need to have a special team to develop the asset itself, because the characteristics of this asset is not like a logistics, which has been in the market commoditized, let's say, up to a point that look like everybody can do logistics. Then when you go to reality, clients do not probably have the same opinion on how people deliver and how they operate these type of assets. But let's say this is like some sort of qualified type of asset. But then if you put equipment on top of it, not only on the electrical side, but also on the cooling mechanical side, then basically the managing of that type of assets start being more complex, which basically means that not everyone, so we are not foreseen to see family offices, even if they are large, entering into this business to do, all the operation themselves. So I think there's some restriction there. And of course, don't even mention if you need to go to colocation like big operators are doing as well. So I think this is a little bit different to the sort of or kind of type of real estate assets we have seen in the last the traditional ones like offices or shopping centers or some point in time logistics. On this business it's not commoditized yet, and there are a lot of you need to have experts really in your management to try to invest in this sector.
Okay, that's fair. You touched on something I want to pick up on, and then with regards to a question to Andrew, which is, you have as you said, a more operational focus in terms of how you want to generate returns from DCs and from your data centers business. In a minute, I will come back to you because I want to talk about the type of returns that you are targeting from a numerical perspective. But passing over to you first, Andrew. SEGRO's, I guess, given quite a lot of messaging around your preferred route, albeit you haven't specifically said we're only going to go down route A. But what if you just talk about kind of your thought process between choosing powered shell versus or more on the operational side, the kind of difference in returns that you think would be generated or will be generated going forwards, and then linked to that, I guess why on a risk-adjusted basis you'd lean more to one way than another, if that makes sense.
Sure. Yeah. Thanks, Rob. I'm glad you mentioned right up front the risk-adjusted, because clearly the risk is different. So for us, there's a few things in here. First one is, as I said before, it's not the full 104 years, but we've got 20 years experience on the Slough trading estate of delivering the shell model. So that's relevant first from an execution point perspective. We've got a lot of experience in doing that. Just getting specific, the returns, I'd say on the returns from that model, they are really strong, ignoring the risk for the minute. Just on a absolute level, the returns are very strong. We target a development yield on that between 8 and 12%, and that range being driven by, at the lower end, where you buy in land and you buy it in at DC values. And that's another topic we could cover. There's definitely a bifurcation now that land that has power and planning for data centers is higher value than land for other industrial uses. So that'd be the bottom end of that range. At the top end of that range, if you've got industrial land held as industrial land for redevelopment, then you'd be pushing towards the top of that 8 to 12% range. So the returns are very good. And the other thing, not only the returns very good, it's also when you look at absolute rent and the intensification. We gave an example. We did a capital markets day back in the summer, and I gave an example in my presentation there where we had a previous generation industrial building on a site generating £700,000 of rent per annum. We knocked that building down, redeveloped it for a higher density data center, and rentalizing 3 floors and the plant deck, so 4 floors at full rent of that building. And it was higher density because you don't obviously need the same size of yards and through flow around the building. And that £700,000 of rent became £10 million of rent per annum. So the attraction for us of that model, is very clear. That generates very strong returns in terms of that development yield range that I mentioned, and secondly, very attractive as well, just in terms of the amount, the intensification and the amount of rent that you can generate from one site. And for us, moving on to the risk side of that equation, we've got a lot of expertise in doing it, and the shell model fits with our business model. So whether it's urban logistics or big box logistics buildings that we're developing in the rest of our portfolio, and we're obviously focused on industrial and warehousing, it's essentially the same business model. So it fits from that perspective as well. But as you said, so that is the way we're thinking, and where it is feasible and practical and the economics are attractive on a risk-adjusted basis, we will generally seek to do that shell model that has served us well. However, as you said, we do have an open mind where that isn't practical or feasible. will look for other options. Now, to be date, which is really value maximization because of the, as I said, the value.
But give me an example of where it wouldn't be practical or feasible. Give me an example where you'd say, you know what, we're not going to go powered shell option.
It could be a location. Yeah, we're all about getting scale. So if we feel it's a location where do we really think we're going to be able to build scale in that location, that might be one reason. And another one might be, being honest, not all DC operators will take powered shell leases. It is a smaller subset, so you do need strong demand fundamentals to be able to get a deal on a powered shell that works for the economics and is going to get you an attractive return in that range. So it could be economics, it could be the location, and or there are, it's fair to say there are some jurisdictions where largely due to things like banking, that the banking regulations and whether DC operators can get funding on the fit out, which is difficult in some countries in continental Europe, that again reduces the attractiveness of the powered shell. So as one example, we sold a plot of land in Italy earlier this year. We got a very good price for it, but there we just made the judgment that probably wasn't going to work for a powered shell, so we sold the land. And that's where, you mentioned we got an open mind on other models. When we don't think it works for a powered shell and we're almost in value maximization mode, if I term it like that, selling the powered land is one option. And that, we've, as I say, that has served us well. The other one, we do have an open mind about, in that scenario, possibly going up the value chain, probably for us, because in the fit out side, we wouldn't have the expertise. Probably we would look to do that by partnering to bring in that expertise in those areas where we don't have it.
Sure. Okay. Fair enough. 8 to 12%. I mean, if we're doing traditional logistics development, we're probably more like, I don't know, 7.25 to 8 yield on cost, something like that, maybe. So, would you disagree with if I made a statement along the lines of, if a DC is an option, it should be the route that you go down for a particular site, given the higher return versus traditional logistics, subject to views on relative rental growth expectations on a long-term time horizon? I would
agree with that. I'd say typically you're right. For those traditional industrial, you'd be in the 7 to 8% range. So given 7 to 8 and 8 to 12, that'd be right. I mean, but even when we look at the Slough trading estate, where, as I say, we've got a real hub, do we ever see that being all or even a majority data centers? We don't actually, because your point there is where, if the characteristics are there, and Michael described it really well, you need to be in the right location. You are in Slough as one example in terms of fibre and close to customers for that cloud business. And that's definitely where we are targeting that. And then you need to have power and planning. So where you have all those characteristics, and that will not apply across all of our portfolio or even the majority, then I think it is as simple as that.
I might just chip in if it's all right, Rob. I think actually,
please do.
In a lot of these scenarios, as I look at them, you don't necessarily have to go down the route of building the powered shell. I think, to Andrew's point there, if you've got a good site in the right location and you've got power, you'll probably find that the data center operators will pay you a suitable premium for it to make it worth stepping aside.
I should give you a call. Francisco, Merlin's model is different, right? And you're taking some more operational risk. When we speak to clients about Merlin, one of the common questions they have is around their concern around how to price that operational risk. I'm not necessarily expecting a numerical answer from you, but maybe something that you can give in terms of a bit of colour for the route you've gone down, why that's the route you've gone down, and thirdly, linked to that, what you can say to the 100+ potential investors on the phone, on the webinar, that can kind of manage or allay some of those concerns that they might have around the risk-adjusted statement that Andrew was making earlier.
Yeah. So as commented, basically we go a step further to what Andrew was describing before. The thing that basically we do is that apart from basically building the assets, and of course getting the power and the planning and etc., and have a building ready, then what we are doing as well is introducing the equipment on the electrical side up to the rooms where the servers will be allocated, and also basically including the system with the mechanical engineering equipment, basically which guarantees a certain cooling to the site, to the rooms where the servers are located, so you can basically guarantee certain levels of humidity, PUE, and all these different KPIs. So the point why we went there basically was first because of course you are going to a larger number of clients. So of course what Andrew was describing, sometimes is a little bit more. They target basically very, very large clients that they have their own equipment, that they can basically assume this electrical and mechanical investments. But sometimes there are others that basically are, they let's say prioritize to be ready, and if they get everything, let's say, done, and the only thing that they need to put basically is the racks and the servers, and completing the fit out and operate basically is better for them. So the only thing that differentiates one strategy to the other, apart from more money, and what we will see in a second of this risk adjusted basically, is whether you can add some value to that proposition as compared to what clients will find. In other way, if you can provide them with equipment or an infrastructure basically that guarantee them, for example, in our case, no water consumption, a pretty low PUE as compared to what the market is normally delivering, etc. So if you have that capacity, then it makes sense that you go a little bit further. So we have on that sense, basically, we partner with an American technological company that basically designed this type of edge type of technology, which for countries like Spain and Portugal, where we have not a lot of sun, but very lack of water in some parts of the year. For example, having a technology that is not water consumption, not consuming, is very, very interesting. Also on PUEs, basically, we're getting to levels of 1.15, which is pretty low and makes super efficient, which basically that in a way competes or at least adds another layer of service to the clients that, when they're looking for that, and they need not only to find their chips for different providers and put in their servers and trying to operate and sell their AI or cloud services to their clients. If on top of it, they also need to look for the procurement of these mechanical and electric components, then is basically their time to market is much longer. So what they, let's say, will pay more is to have this access. So from our perspective, just having that capacity of providing this, of course, is higher risk because you are putting more money, more investment on the asset first, and second, you need to maintain all of that equipment. So that's the reason why in terms of the returns we look for, we need to ask for more. That's what we were commenting before. So this 8 to 12 in our case is more 14 to 15. Just because basically we are first making more investment, and secondly we need to maintain that for the client. Okay, the only thing which for the comfort of investors is that all what is linked to equipment basically is of what we understand, the servers and all the softwares and the stuff basically is on the final client that at the end is the customer of all these assets.
I remember speaking to someone a while ago that was talking about issues with getting hold of gensets, for example, from Schneider or whoever it might be who was making them, and the time delay, which you alluded to. To what extent, I guess, when you think about the pace of rollout of your phases of DC development, what's the constraint that results in the rollout being at the current guided pace and not faster? Is it availability of capital? Is it tenant interest? Is it availability of equipment that you need either from electrical or mechanical perspective, from a fit out point of view? Like what's the driver of you saying we're going to do X by 2028 rather than by 2027 or whatever it might be? Maybe it's planning or power, I don't know.
Yeah. So
Why can't
once
you go
have the plan-
faster?
no. Once you have the planning and the power, which basically means that you can start building and you have the power to be connected there, which is basically without that, I mean, shouldn't put capital allocated to that business if you don't have that. So once you have that completed,
Yep.
next thing is the procurement of equipment. In our case, basically on a significant size. So right now in Europe, we don't have a constraint on that, which means that it's not that you have immediate access to that equipment, let's say in a month or 3 months, but you also know that your asset will take you between 15 and 18 months to be developed. So right now, and probably things will change in the future, but as of today, there is no part of the equipment that will be delivered in a longer period as compared to the construction part. Okay, so there is nothing that will take more than 18 months.
I understand.
That said, we cannot be blind, let's say, seeing that in the US is not the case. So in the US, they take the same time to build, let's say. If they're more, let's say, automatized, probably, they in 15 months. Normally here in Europe, we do several floors. In the US, is more, unique floor or one or two floors only because they have more space as a country, let's say. So this a little bit different, but in any case, they have some sort of shortage of equipment which can exceed the time of construction. So that is one of the things that were very important. And for us, when we launched the capital increase before summer, part of it basically was precisely that. So in some of the cases, we need to put orders of equipment. So we need to, in a way, buy the slots for getting that equipment. Yep. So when we finish the construction, the civil construction of the asset, the equipment is there ready. And this is, as with this proximity to logistics, and that Andrew is an expert on as well, is the clients, they give a lot of value, and in this case even more than in logistics, for the delivery dates. So the client are really skeptical of entering into a contract with somebody if they're not sure that they will get their asset at the time they want. Or has been convened, let's say, in the agreement. So in the same way that for a logistic, you are creating a huge problem if the client is not getting their warehouse, so they cannot provide to their final customers basically the service. Here is exactly the same. And if you bring this to the most let's say obvious case, imagine that you have a server which a data center will help on the Black Friday. So if they have a plan for that, not having that from a logistic point of view is a disaster. From a data point of view, is an even higher disaster. So that's basically very, very important. So that we can accommodate all of this timing together to, for the benefit of the client.
Have you seen a big percentage increase in terms of equipment pricing in the last couple of years, in terms of inflation of equipment pricing, given demand relative to that kind of tighter supply / lead times to get delivery of equipment, etc.? Either Andrew or Francisco.
So from our part, very, very quick. Yes, of course, there has been an increase. First, because there are not so many people doing the type of equipment that these assets need. So we don't have, so far.
Roughly how much? Can we give a number?
It depends on the component. So if you go, for example, to transformers, then there are many people doing this, because not only us, it's all the, the grid that requires this type of assets. But if you go for generators, let's say, then it's different, because, the type of generators you have normally are for, infrastructure, which are not a lot, not super common in the market. You go to batteries, there's a lot of people, but then you put it together with the, the other part of the UPSs, then is complicated. So, it's like at the time of logistics, when there were a lot of people trying to get in, and the price of the steel and etc. basically went to the roof. Here we have probably will suffer that, but at the same time more people will come as well to the market and will, let's say, change a little bit the type of product that they're doing. On the civil, I let Andrew comment on that. That probably has a lot of experience there as well.
I'm just almost trying to implicitly take a view in my head as to whether I should be, with my investor hat on, buying a Merlin or a SEGRO, or whether I should be buying a equipment provider, because maybe I've got stronger earnings growth from the latter rather than the former. But that's a question for another day. Andrew, you've given a time frame for those 24 sites that you talked about at the start of the call, roughly over the next decade. That's quite a long time frame, to be fair, to think about, or for investors to get excited about. And I don't think you've necessarily given a breakdown in terms of, you know, what happened in years 1 to 3, 4 to 6, etc. But I just wonder, some of those sites, is that, you know, that might be in years 8 to 10, is this just because we've got a tenant in place and we need to wait till they leave before a site becomes available and we can do another, you know, conversion of 700 grand to 10 million or whatever it might be? Or, you know, what's the bigger constraint there?
Yeah.
In terms of, because ultimately DCs will be I think we wrote a note about this a few months ago that was called the Next Industrial Revolution, and, you know, DCs on our numbers becomes, you know, goes from roughly 8% of the portfolio to potentially closer to 20, depending on how big the non-DC portfolio grows over the next kind of 7 or 8 years type thing. So it's quite material, right?
Yeah, it is material. Yeah, it'll be a minority of our overall portfolio, any which way, but it is material. And I mean, turning it around another way, there's quite a few factors governing that. You're right, we haven't given a breakdown, and deliberately so, because of all the unknowns in here. But turning it another way around, you know, I always say the data centers are different to a lot of other classes. You'd say generally, and I ran our UK big box portfolio for 5 years in the UK, you generally say the constraint on pace of development, yes, there's how quick you can bring a site forward, but generally you'd say the pace and how fast you can develop out a site once you've done the infrastructure in normal industrial, if we term it like that, is customer demand. It's how quickly can you develop out that site is primarily, you'd say the big constraint is how quickly can you get the deals done, whether you're doing those spec or you're doing them pre-let. And data centers is different because we've said there is huge demand. There is a big wall of demand out there, and Michael mentioned it. The constraint is really land and power. So when we look at, to answer your question, why is it spread over those 10 years? It's a bit of all of the above. So I think anyone that says, you know, we're very lucky in terms of that power pipeline that I talked about, most of that is secured, but, you know, power, that there is timing to bring that power on stream. Secondly, there is timing to get planning for those sites. And the third one you mentioned, some of those sites, and to be honest, particularly those at the back end of that time frame in the pipeline, they are redevelopment sites. So as with any other industrial redevelopment site, you need to, there's dates at which you can get vacant possession of, you're certain you can get vacant possession of the sites. In some cases, if you can get it earlier, you'll bring it forward earlier, subject to the power and the planning. So it is a bit of all of the above. And the fact there's quite a few factors in there, and some of those are unknown, is why we have been pretty cautious in putting a timescale out, other than to say it's most definitely in our interest. Obviously, we will bring that pipeline through as quickly as we possibly can. You know, we talked about the returns before, which are very attractive. If you've got land sitting there or in existing industrial buildings, you know, we are heavily incentivized, and we're working incredibly hard as a team to bring those sites forward as quickly as we possibly can in that time frame. But, you know, as Francisco said, DCs are a business where, you know, there are there are relatively long lead times because they're big, capital intensive, complex assets.
Mike, on the subject of bringing sites forward, I wonder if on a kind of no names basis, you're quite interestingly positioned in terms of your ability to talk about a kind of client breadth rather than necessarily individual corporate depth around, you know, some of the kind of typical process that you either might be working on for a client or may have worked on for a client in the past. And I guess, you know, why do they come to you? You know, why do they not, you know, necessarily always go directly to a Merlin or a SEGRO? Or, you know, how does that kind of end-to-end process work for my understanding? And I'm sure some people on the call have a similar question in mind.
I suppose so. You're absolutely right. It has to be on a no names basis. They take confidentiality very seriously, so it will be on a no names basis. But, you know, I would have an operator come to me. They would initially, you know, 4 years ago, they would have just turned around and put a couple of circles on a map and said, this is where we want to be. Can you go and find us some land in this sort of area? And it needs to be 20 acres or so. And we need to talk about power and things like that. the interest in the investment into data centers has meant that actually not only am I obviously still doing those sort of land requirements, but also now looking across Europe. So I think that's probably an advantage that BNP can offer, because obviously we have this big network across Europe. But also they're looking, we have the banking side of the business with the infrastructure and telecoms funds who are very focused on M&A activity and things like that. So again, having that across Europe is really helpful as well. So I think the conversation has gone from being purely land focused initially to now moving on to actually, is there any other way of getting into this data center market? Is there any other way of receiving, getting on the upside of having these long lease terms to good covenants? And it's coming through M&A activity, and so I think the ability to work across Europe and with the bank is very positive from my perspective.
Okay, interesting. For those of you listening in, as a reminder, if you want to ask a question, please click in the Q&A box and type your question, and I will read it out. That'll be really helpful. We'll come to those questions in about 4 or 5 minutes or so. One of the topics that I've read about is around kind of AI-enabled DCs versus non-AI. And I wonder, for everyone on the call, number one, what does one need in terms of difference in products to facilitate that kind of usage of the data center? And what does it mean in terms of difference in costs, potential returns, location, proximity points, etc. And treat me as a novice with regards to the answer. Andrew, why don't you get first?
Yeah, I'll go first, and I'm a relative novice on this as well, so I'll keep it nice and simple for you, Rob. So the way I see it, the way I understand it, there's primarily 2 types of AI. So there is inference AI, which is where users are actually using AI. And from our perspective, when we're looking at demand, I think, this is all nascent and embryonic still, although AI is out there and a lot of us will be using it. It's we're in the foothills, but inference AI, the way we see that, it's going to be pretty similar to the main demand that we get for data centers right now, which, we term generically as cloud. It's us all using mobile phones, mobile devices, banking, all the things that we use data for, driven by the cloud. That is the main driver of demand that's driven all of that demand for the data centers I talked about in our portfolio.
Sure.
And early days, but we think inference AI, where the same applies. You need that latency and that fast reaction time users. So therefore, logically, data centers are going to have to be in similar locations. Then you've got the other type of AI, which is broadly termed generative AI, which is really, I always think of that as teaching the AI. It's also called machine learning. So it's teaching the AI to do what it does. It's really clever AI, but it takes an enormous number of hours of compute time and huge quantities of power to do that part of the process. Now, again, very early days, but the way we see it, those centers, the proximity to users and the fiber network is less important for those facilities. They will need gigantic amounts of power. So we sort of think it's probably likely that those sorts of data centers are likely to be much more footloose, probably located near to sources of power and sources of huge amounts of low carbon power. And so they are likely to be springing up in a much wider geographical range, and in locations that haven't traditionally been data center locations. The other thing about data centers, they cluster for a reason, because not only because they are good locations in terms of power planning and fiber and close to users, but the data centers communicate with each other. So there is a big natural clustering effect that probably won't apply to generative AI. So that's how we see it. And, we think most of our locations I talked about in our pipeline, there's going to be still huge growing demand from the cloud and probably inference AI as well. So that's what we'll be targeting with our pipeline rather than the generative AI locations.
Okay, understood. Francisco, anything to add before I move on to the next question?
Yes, just adding a couple of points. I mean, from a technical point of view, AI, as Andrew described, basically they also need more density, so they absorb all this capacity because they put more computing capacity in a smaller place. So in a way, a room that you have with a density where you put certain number of racks on a cloud or inference mode, they have a number of racks per room. But if you basically put the other type of AI, much more consumer of power, in that case, basically what they do is, in order to optimize the computing processes, they put more computers, let's say, in a way, in the same space, which basically obliges you to have more power concentrated in a single room, more mechanical investment in order to take out all of this heat out of the room. So all of that basically is a component which affects a lot to design of the building, if you want to target this type of clients. The second thing I will add, if I may, is basically the type of equipments they have. Basically also have a big impact into things. The first one is their time to market. So there is no ramp up normally in AI because they made a huge amount of investment in servers. So once they have all of that capacity, the ramp up, so the time they need between they sign the lease and they are at full speed, basically tend to be pretty short. When they are more on the cloud, they normally take a space that with different ramp ups, they are little by little taking space and putting basically in operation. That also means that if they put more servers all the time basically in use, means that their amortization time for that equipment is much quicker than in normal, let's say, cloud type of client. So which means that if you go to cloud, normally every 5 years they tend to renew the servers. So this is basically the life expectancy of the equipment. If you go to AI, where they have a much more computing processes, normally they go to, in 3 years they need to replace the machines. This also has an effect on the length of the contracts they sign, because if you are every 3 years basically renewing your equipment, you don't need to like sign 20 years of contract, because every 3 years, let's say, you can have another review. If you have basically more equipment that is amortized over 5 or 6 years, normally they tend to go at least to that maturity. So they're normally more tempted to sign 7 to 10 years, just counting on the number of times they need to renew basically their equipment. So that's, I think, just to add a little bit to what Andrew said.
I'm going to do one more question from my side, because now I've got too many questions from the audience to answer in the time allocated. Yields. So obviously one component of our total return clearly is the ability to grow rents or to grow income over time. But another really important one, I think, when thinking about your total accounting return is what happens to yields and the yield outlook going forwards. I wonder, maybe this is initially a question for Mike, around, have we seen any transactional evidence recently? Do we have a view in terms of the direction of travel, of yields, and maybe ignoring what's happened to risk-free rates at the moment, but maybe it's yields relative to sheds, for example. Can DCs trade tighter yields than sheds? I just wonder if you got any initial thoughts, and then happy for anyone else to jump in afterwards as well.
Yeah, so I think it's worth bearing in mind and just giving a bit of background on that. In terms of our core markets within the data centers sector, you've got something called the flat markets, which is Frankfurt, London, Amsterdam, and Paris. And so, relatively speaking, though any activity in any of those markets is roughly a core market, and therefore it should be sort of treated more or less as the same. And so there's been a bit of activity recently. There was an asset that traded in Amsterdam, and there's been an asset traded in London as well. They tend to be sort of, sub 5% as a net initial yield. And so if you're comparing that to prime industrial units, well, frankly, the guys on this call are probably a better place to answer that. But I expect that to be, prime industrial yields to be about 5.25, maybe on a good day, maybe 5.5 on an average day or something. So it's, you've got 50 basis points in the difference there, I would have thought.
Yeah. Anything else to add, Francisco, Andrew?
I just
go on, Francisco.
So I'm just basically saying that there is also components. I mean, there have been, from our point of view, not a lot of land to be transacted in the recent months. There has been as well companies, because they, as commented before, basically that experience of knowing the clients and having the experience to operate a data center is not really abundant in the market. So the different big pockets have already taken several companies. So there is, I would say, basically a premium right now on platforms. Together with the assets, but I think as this is pretty new. Apart, if you're, looking at Europe, not taking US as a proxy, there are not so many, let's say, private capital, big institutional capital entering this type of assets yet. But once I think the people are more accustomed with this type of panels, they will basically know more about what this type of asset is. I'm pretty sure that we will see this in the future, because it will attract a lot of interest of people. So I agree with Michael that it will be pretty competitive yields, as compared to other real estate assets.
Can I sorry, just add a point there? I think to Francisco's point as well, these assets don't trade very often. They're valuable assets, and people don't put them in the market if they can help it, I think. And if they do come to the market, it tends to be the operating party that looks to buy their freehold 99% of the time, and that's how they drive pricing slightly.
Okay, understood.
I'd just add to that, I think all of that is right. I was going to say the market's very thin, particularly for the when you get into the fully fitted. And to be honest with you, I think that's right. All the factors that go into the yield on any other building come to play, and not least, lot size. And when you get into big, fully fitted data centers, depends on how good the market is, right? But the lot sizes get very, very big indeed. And so I think the guys are right that most of the transactions we've seen tend to have been platform transactions. And, again, it's early days, because you can have data centers valued at, £1 billion, billion euros. So they are very, very big assets in terms of liquidity, and then all the other factors that go into valuation, quality of building, location, and critically covenant as well.
Okay. Okay, so we're going to do quicker fire. Andrew, one on rental growth. The question talks about hyperscalers seem to have acted as a constraint on organic rental growth. AI has boosted demand for DC space. What's your outlook for like-for-like rental growth trends? You can't just say positive or good. And secondly, maybe more numerically, it says what rental growth rates, levels, percentages are you forecasting in your models?
I'm going to disappoint you here by saying, it should be strong. Fundamentally, the rental growth we're looking at for the building, it should be driven by and linked to the pricing for the underlying data centers. So, I would say, like in all the other buildings we get in the UK, we seek to put in rental growth clauses that, wherever possible, are the higher of indexed and open market. And, I would say for us, that open market piece is important, because that open market rent for the underlying building should be driven by the pricing in the data centers. And given the supply and demand dynamics that we've talked about, that should be strong. So I haven't used the word good, I'd say strong.
Okay, fine. I think I bad the strong as well, but we'll let you off. I've had two questions on obsolescence, actually, Francisco. So I told you it was going to be a topic on people's minds. What are we factoring for CapEx, or in terms of, or maybe the question more is around useful economic life, actually. How do we think about asset obsolescence and kind of degradation of value? And is there a risk that, you have product in place today that in 5 years' time becomes obsolete at a faster pace than you are currently forecasting, and thus your enhanced yield on costs gets compressed closer to an 8 to 12, for example?
Yeah, that's a very
I'm being slightly pessimistic, but it's an important point, right?
Yes. So I mean, for the benefit of the colleague that has asked that, there are like three types of solutions here. So one basically is the design. So you make basically the building, and all of a sudden, like in a logistic warehouse, you were doing stuff, years ago of 8 meters high, and all of a sudden people want basically 12. So if you have not that design, you are not, let's say, convenient for certain clients. So that's one thing, is design of, the building infrastructure. Second one basically is on equipment. So you put all this equipment that we were commenting before, and what happened if there is new equipment, new technology basically coming into the sector. And the third one basically, which is the one that people tend to ask without knowing it, is basically on the servers. So people are always scared that, all these guys of, NVIDIA, AMD, and Intel, whatever, basically all of a sudden, compresses the size of the stuff. And then all of a sudden they don't need that much space, because, they can basically have, like big rooms of IBM in the old times, basically now compressed, in a smartphone. So that's basically what people tend to have. So that part, this is not our business, neither Andrew or ours, basically. So it's not the risk we are assuming. And what we can see on that fact is that the demand is bigger than the capacity of the hardware guys to compress the servers in a small space. In reality, right now we're going to the opposite. So they're going to larger servers in order to make that capacity available. But this is not our business. So on the design and on equipment, of course, there will be changes in the future. What I can say basically is that not everybody need to be ready for the last model of NVIDIA that requires X or Z qualifications. Of course, if you are having a new building, you need to be at the edge of technology to offer to everyone your building. But not everybody needs a Ferrari to go to the supermarket. So there are people basically that there are businesses where they enterprises, collocation, where they can live with certain characteristics, which doesn't need to be the end, the last version of that. So in terms of economics, these assets basically are heavily invested on a redundancy basis. So we have a lot of systems that are only, let's say, installed in case that the prime systems are not working properly, and this in certain levels. So sometimes, depending on the number of ends you have, basically you can have like 3 systems to make one, which means that one is at work and the other 2 is just covering potential blanks that you could have there. So on that sense, it's really highly costly to maintain all of that. So all that equipment that is not used, let's say, in a way. Okay. That said, all of that is including in this type of yields. When we talk about yields, this includes basically the sinking funds and the different provisions of changing that equipment, which, by the way, taking servers apart that I mentioned before, which very quick 3 to 5 year change obligation. Equipment normally, apart from the batteries, which normally can last up to the 7-8 years, most of the equipment is like 15 years life expectancy. So it's not something that you need to consider at the first day, but as you said perfectly, you need to have some sort of sinking fund preventing that in 15 years you will have a significant capex, and you need to reserve part of the money to cover those.
Very clear with 1 second to go. Team, thank you very much, Andrew, Francisco, and Mike, for your time. For those who followed in, appreciate you giving up the time today as well. Apologies we didn't get through all the Q&A, but if you wanted to reach out to SEGRO or Merlin afterwards, alongside BNP Paribas Real Estate, they're more than happy to engage with you and help you out. And thanks again to the team at EPRA as well, and we will catch you soon. Thanks very much. Bye-bye.
Thanks. Bye.
Thank you, everyone. Thank you. Cheers. Bye.